Hi, I'm Simeon Willis. Welcome to this market update for the third quarter of 2023. We've had some action-packed quarters over the last year or so, but this one has been a bit different. Inflation seems to be heading in the right direction and growth assets appear to have done reasonably well, meaning that combined with further gilt yield rises, pension scheme funding levels have been boosted further. But there's a little bit more to it than that. The performance of growth assets aren't quite as strong as appears due to the currency effects. And the gilt market has got cheaper at long maturities, but more expensive at shorter maturities. Don't worry though, we're going to unpick this one together. And today, to help me to do that, I'm joined by Duncan Maloney, a senior consultant in our Manchester team, who's going to share his thoughts on some of the key developments over the last 3 months. So Duncan, what better place to start than taking a look at global developed market equities and how they've performed?
Thanks, Simeon. Looking first at developed market equities, for unhedged UK investors, global equity returns were positive over Q3. However, this was primarily driven by the weakness of the pound over the quarter. In local terms, North American equities, which make up close to 75% of the MSCI World Index, actually fell by around 3% over the quarter. The US economy has remained resilient, with unemployment remaining low despite the interest rate increases that have been put through by the Federal Reserve. This has lessened concerns about an imminent recession in the US, and it's been reflected in the year-to-date returns on US equities, which is close to 12%, despite that fall of 3% in the third quarter. The tempering of US interest rate expectations has lowered the perceived risk of a recession. However, economic data is contrary to this. Japanese and UK equity markets were the standout performers in the third quarter, returning positive 2% and 3% respectively. Fiscal and monetary policy have been favourable for Japanese stocks, and in the UK, more value-orientated stocks have performed well, particularly in the energy sector, as oil prices have increased by around 30% over the third quarter.
Thanks, Duncan. Now to talk about interest rates and inflation. At our recent webinar looking at the LDI crisis 1 year on, I shared some thoughts about what's driven the rise in gilt yields recently. If you'd like to watch the webinar on catch up, you can click the link where you access this video. Now, in summary, the rise in gilt yields is a combination of central banks increasing interest rates to stem excessive inflation, the increase in expected issuance of new gilts combined with the unwinding of quantitative easing, as well as a declining demand for new gilts from pension schemes. Now, inflation has been heading in the right direction more generally. In the UK, the 12-month CPI rate of inflation has fallen from 8.7% to 6.7% over the last 3 months. But UK inflation still exceeds other global economies. In the euro area, inflation fell to 4.3% in September, and in the US, CPI was 3.7% in August. The Bank of England increased the bank rate to 5.25% at its August meeting, but the subsequent reduction in the rate of inflation in the UK was enough to prompt it to pause interest rate rises in September. However, it did decide to increase the rate of quantitative tightening for the forthcoming year from 80 billion to 100 billion, which would apply upward pressure on gilt yields. Both the Governor of the Bank of England and the Chairman of the Federal Reserve issued warnings that there's a long way to go in the fight against inflation before rates around the world would start to come down. Now, over the quarter, longer-term gilt yields have risen by about 0.5%, but curiously, short-term gilt yields have actually reduced. This has led to some variation in how gilt portfolios have performed depending on their maturity. Shorter-dated funds will have fared better, whereas longer-dated funds have delivered substantially negative returns. Now, lifting our sights beyond the UK's economic challenges, let's spend some time looking at emerging markets. Duncan, can you talk us through what you've been seeing there?
Emerging market equities is an interesting one, as you may well have seen in the financial press that there's been significant concerns over the health of the Chinese economy, and the Chinese economy and the stock market make up around a third of the emerging market equity index. Despite this though, emerging market equities fared well over the third quarter, up 2.6% in sterling terms, This positive performance was thanks largely to the strong performance of tech stocks, which make up around a fifth of the emerging market index. China's property sector woes were compounded in September by the news that the chairman of the real estate giant Evergrande was under police surveillance and trading in that company's shares were suspended. Evergrande is at the centre of a real estate crisis, threatening to undermine the broader Chinese economy, which could pose a wider contagion risk for other emerging markets.
So now we're going to take a look at the bond markets. High yield bonds had a strong September and were the best performing asset class that we've shown here. However, most of this performance resulted from the US dollar appreciation relative to sterling, which fed into the global high yield index return. Broadly speaking, investment grade and high yield bond spreads now look pretty tight. This might seem surprising, in particular given the observed default rates that have risen substantially this year and are expected to continue to rise in the coming months. However, the tight spreads may well persist given strong demand and fewer companies issuing debt at current levels. Now we're going to take a look at the funding level of a typical pension scheme.
It was a bumper quarter for aggregate UK DB pension schemes, as the combination of moderate growth asset performance and falling values placed on liabilities saw funding levels on a low risk basis reach new heights again at the end of September. Long-dated gilt yields rose by 50 basis points over the third quarter to heights last seen in the gilts crisis of 2022. And what that means for a pension scheme is that a scheme with liabilities of an average duration of 15 years will have seen around a 7.5% fall in the value placed on those liabilities. So a really material move for just a single quarter. At the same time, long-term inflation expectations have remained relatively stable, so there'll be limited impact from this. 1 year on from the gilts crisis, pension schemes are better funded than ever and are well placed to learn the lessons from the fallout of the infamous September 2022 mini-budget.
Well, now let's have a look at the outlook. Our views haven't changed markedly from last quarter. We remain favourable on some of the medium to lower risk income-driven asset classes, including direct lending and long lease property, in light of the decent spreads and investor protections these asset classes offer. We've also upgraded secure income to favourable for similar reasons. We're favourable on diversified private markets, given that in the main we're seeing opportunities for investors who are willing and able to tolerate illiquidity. But we're neutral on liquid credit and equity markets, seeing both upside and downside pressures fairly evenly stacked. Duncan, please can you share your thoughts on equity protection, buy-in and cash investments?
So taking equity protection strategies first, at the end of Q3, low implied volatility and higher interest rates are actually keeping the price of downside protection at a 3-year low, and therefore we have a favourable view on equity protection strategies right now. Next up is buy-in. So despite slight increases in the pricing for pensioner buy-ins, the spread relative to gilts is still above historical averages, resulting in a favourable outlook here. And finally, cash. I'm sure it hasn't escaped you, but the attractive yield available on cash and money market investments at the moment as a result of interest rate increases by central banks mean that whilst opportunities remain elsewhere, the current risk return profile on cash is attractive at current levels.
Well, with that, we've come to the end of this market update. In summary, it's been a mixed quarter. We've had some positive growth performance, although in the main driven by sterling depreciation rather than stellar growth performance. The global economy seems to be entering the next phase of inflation management, and the inflation fire hasn't yet been put out, but does seem to be coming under control. But amongst all of this, pension schemes are better funded than ever. I hope that's been helpful. If you'd like to find out more about any of the topics discussed, please reach out to your usual XPS contact or get in touch with me or Duncan. You can also access our latest insights via our website. That's it for today. Thank you very much for joining.